Hi, this is Lex, and welcome to the FinTech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Pat, welcome to the podcast.
Thank you, Lex. Happy to be here.
It's really exciting to get you on here because we actually spent a lot of time together on various Zoom calls and other versions of voice communication because we work together at ConsenSys building Codify. And I think the conversations that we're privy to around Ethereum and fintech and what's happening to financial services, our listeners here would find really fascinating because it's actually what's being built on the ground in decentralized finance. So I'm really excited to open up this conversation. But before we hop into that, tell us kind of where you come from. Like, what's your background? How did you get into the space? And what's just what professionally, what have you done?
Sure, absolutely. Yeah, I'll just say to the listeners first, Lex is always great at doing things well and then upping the ante and doing things even better. And in this case, Lex always likes to make me feel uncomfortable, and he has succeeded in upping the ante by getting me on a podcast to do it. So well done as usual, Lex. My background, my background is I'm a lawyer coder, actually. So I was a computer science math guy in undergrad, and I went to law school, practiced law for several years at a financial services industry law firm, Sullivan and Cromwell in New York. So did a lot of securities industry and kind of financial industry work there. I decided to get out of the law firm world and get into the kind of software innovation world. I did a year where I co-founded a health tech startup, and then I joined ConsenSys, and I've been at ConsenSys now about 4 years and have kind of really been focused at the intersection of crypto, blockchain, financial industry, financial markets, and regulation and public policy. And in obviously the work we do together there, it's kind of building the products and business that helps kind of push the financial industry forward.
I've never asked you this, but the math and computer science in undergrad transitioned into Sullivan Cromwell, and I think you were a real lawyer, not a corporate lawyer. So how did that happen?
To my corporate lawyer friends who may be listening, I apologize for Lex's jab.
I'll take credit.
You're a real lawyers too.
Someone's got to take notes.
Yeah, of course. So, as you know from talking to me, Lex, I always like to kind of I guess, argue and debate and kind of probe the tough questions. And I think, perhaps in part because of that, I think growing up, I always thought I wanted to be a lawyer. My dad was also in law enforcement, and so maybe that was a piece of it too. But I always wanted to be a lawyer. And when I was kind of going into college, I guess I initially entertained the idea of, poli-sci or econ or something like that, which is a pretty common path to go to law school. But at the time, my dad was very insistent that I should, that technology was going to be the future. At the time, he was working for the federal government and doing some kind of computer forensics stuff with them. And he was pretty convinced that, computers and computer science was going to be really big in the future. And he told me, I should do something in that just in case I didn't want to do law, at some point in my life. To his credit, I think he was right. To my credit, it was one of the times I actually listened to him. And so that's how I ended up doing kind of computer science math in undergrad, but then still going to law school and only deciding, several years later to move into the technology kind of innovation side of things.
That's fascinating. And actually, there's a number of folks in our industry with a background where they have a real technical education and then I don't mean to rile on lawyers. Lawyers are the best. I have a legal degree. It's great as decoration on your wall. So you actually practice law for quite a while, and that experience in interfacing with the financial industry as it's situated and formed traditionally through the law is really informative. For me, that was the collapse of Lehman Brothers and the experience of the bankruptcy of Lehman Brothers and watching all of these highly levered positions get unwound and sort of fall apart, but then the human aspect of lots and lots of people losing their livelihoods and sort of the behavioral mistakes that lots and lots of people made buying at the top, and kind of got woven into my DNA to think about personal finance and go into robo advice and think about digital investing and automation around those mistakes. But I know that for you, the practice of the law and sort of the work that you were doing gave a similar window. Can you talk about that a little bit?
Yeah, for sure. So, one other piece of my background that kind of factors into this. So, I grew up in Ohio. Grew up in Ohio. Went to undergrad in Ohio. Went to law school in Ohio. And it wasn't until I went to work at Sullivan and Cromwell that I moved out of Ohio, and in that case to New York City. And so, I was kind of exposed throughout my life that I kind of struggle with the right way to describe this, but I think ultimately, the various systems, the opportunities, like they don't quite work the same for everybody. And I know, like, in Ohio, the opportunities for, people to do startups or to do certain types of vocations and things, the financing and the it just doesn't quite work the same as it does for other places. And I think when I moved to New York, when I worked at Sullivan and Cromwell, I started to see more kind of start to better understand why that's the case, and kind of validate that that is in fact the case. I think it really, I'm sure this is a similar to what you experienced, Lex, but you start to kind of see how the system works, and it starts to be very obvious that there's just obvious improvements that can be made. I mean, one of the things that has always that really struck me at the time and just sticks with me to this day, especially with the work that we do, is I spent a lot of time around the Madoff fraud, and doing work around the Madoff fraud. And there was this amazing story from one of the Madoff related trials where, Bernie Madoff, who, I mean, very well respected in the industry, was running a regulated broker dealer business, was running a regulated, investment advisory business. He had one of the top audit firms in the world come to his regulated broker dealer, and they wanted to audit and kind of confirm some of the performance that was being reported for. I think the auditor had been retained by like one of the hedge funds that was working with Madoff. And
And
so
I assume everybody was wearing like suits and ties, and there were no hoodies or any sort of like dangerous hipster buns. It was all to the letter.
I think it was all proper attire at the time. Yeah, there was the attire was not the problem. And the auditors, to their credit, they said like that, they picked like a random date range, and they said, okay, we want to confirm that this performance was actually delivered. So Madoff's people ran in the back room. They created transaction records. I believe they created them from actual trade records from the broker dealer. So they looked fairly real in that respect. They printed them, and then they realized, darn it, we got a problem here. We just printed this, and the pages are still hot, and these really should be records that we have anyway. So then they took the printed trade records and they put them in the refrigerator to cool them off a little bit. Then so the refrigerator did its job, cooled the trade records pages off. Then they took them out and they said, well, wait a sec, if these were printed trade records that we've had for a while, they'd look a little more worn. So they like tossed them around the back room to make them worn and all of this. And they eventually, once they got done working on the records, they brought them out to the auditor and presented them, and it worked. And my mind was blown, and my mind is particularly blown about how that happened in such an important part of the regulated financial industry. And when you start to see the things that are done and are possible with blockchain and cryptocurrency technology, I think it's just the ability for really step change improvement, I think, at least to me, becomes very obvious and very, very compelling.
It's truly an unbelievable story that all it takes is to throw them in the fridge, and crumple them around, and that the best of the white shoe law firms, or one of the best accounting firms in the world, is totally cool with it. But I guess it also isn't a surprise, because Enron, and if you look at the history of money laundering or scandals in financial services, it is all across all of the large financial companies. There was an article recently about, I think it was Capital One, where they laundered like mafia money in New Jersey for between 2008 and 2013, and now have to pay a $390 million fine. And so it still boggles my mind that when people look at the crypto asset industry, that they still think that there is something exceptional around the use of cryptocurrency for illicit activity, when in fact, like, there's nothing easier than to trace your crypto assets on a blockchain. Like it's made for compliance, it's made for oversight, it's made for programmatic like risk management, and it's almost the opposite of the popular opinion.
Yeah, and to be honest, I wish I was better at explaining it for folks who don't understand it, but like it's the thing that's so interesting and exciting is how you can kind of audit and interact kind of directly with the item of value or the representation of value when we're talking about kind of blockchain cryptocurrency. The problem with the various examples we just gave, Madoff, Enron, etc., is you have so many people who are interacting with and relying to great degrees on kind of representations of value that are so far removed from the actual item of value. Fundamentally, in the Madoff case, you're relying on printed pieces of paper about trades, but like, the things being traded and where they're actually being traded and stored and executed and all that, like you get fairly far removed. With the blockchain and with cryptocurrency, you can be right there. Like it's like, the item of value, the token, the cryptocurrency, the rules that are applied via smart contracts or whatever, it's much more easily verified, audited, and it's just not as susceptible to that type of fraud at the end of the day.
And it's also always on. So I have to hat tip to the Fedwire system going offline yesterday, where money just stopped moving, just went down. And in that moment of a network going down, you don't know any of the exposure or where it's supposed to go or which things will break and which things won't break. And that's at the core of so many financial crises. Like in the Lehman case, it was fear about what happens tomorrow and fear about whether your debt's going to be repaid or not that creates a bank run and pulls out all of the funding for your counterparty, rather than, if you actually could account for all of the exposure, you might not be as nervous. But if it's derivatives in the trillions, quadrillions that you think are there, and you can't really count it because it is all just paper, then it's uncertainty, it's risk, and it creates these negative behaviors on a really large scale. So you joined ConsenSys in 17, 18, 16?
Well, I didn't know I was going to be a math quiz, right? I don't know. I can't remember the year. I think it
Yeah,
was, it's
it's a multiple choice question.
17, I think sounds right.
Yeah, so that was a pretty high flying time for Ethereum, and you were kind of front row to the regulators in the US developing a regulatory or like a legal view, and then also the front row for all the token launches in that kind of first iteration of the thing. What did that look like? What was the relationship with the regulators, and how has that changed? And then sort of the nature of the stuff that people are doing on the network as well.
Yeah, it was a fascinating time. We at ConsenSys ended up, working very closely with regulators and kind of policymakers all around the world. Certainly at the SEC, but regulators and policymakers in Europe, across the US and various states. I think ultimately regulators, as I'm sure many listeners know, look, I mean, they were obviously concerned. They were concerned because there was a ton of attention and kind of capital starting to flow into these markets and these products. Now, arguably on a relative basis to the rest of kind of financial system and everything, it was it was still quite small. And I think many of the regulators and policymakers still recognized that at the time. But nonetheless, I think especially in the US, I think they wanted to pour a little bit of cold water on it while let everybody kind of figure out how this all works. But at the same time, I think there was a really distinct and kind of palpable sense of interest and excitement, frankly, even from the regulators and policymakers, in what this technology could, in theory, enable and could improve with the systems that folks were using at the time and still predominantly use today, especially in the financial markets. And so, I mean, we had many, many, many conversations with folks, and I mean, honestly, I was in meetings with some fairly high level regulators where like they were getting excited, they were tossing around ideas for like token models that could like help solve various problems, and it was actually pretty fun and exciting, to be honest. I suspect that many people, if they weren't in those conversations, would have assumed that it was adversarial and heated. But I think, to the regulators' credit, I think they really were trying to understand, they were trying to learn, and they were trying to kind of strike the right balance between letting the people who truly were trying to move the technology and frankly society forward had the ability to do that, but at the same time recognizing, and they're correct about it, when you have these types of huge technical innovations, you get a lot of charlatans and you get a lot of fraudsters that are going around trying to hurt people, trying to get money from people. And so they're really trying to kind of strike that balance between fighting the latter but enabling the former. And I think it became quite clear to me, and I think to us at ConsenSys and ultimately to others across the industry, that, when we're talking about digital tokens, digital assets that people can actually use or consume for various things, that is okay. And not only is it okay, but it's really exciting because it can start to allow people to have, and participate in kind of fundamentally new platforms and networks. And so actually, many of the regulators and policymakers were quite excited about that potential. And also the fact that when you're talking about a network of kind of participants that is, quote unquote, decentralized, a lot of the regulatory rules that apply to kind of financial instruments, they shouldn't logically apply to a kind of quote unquote decentralized network of participants. And, I think that, various statements and rules and things have come out since then to kind of even make that more clear. But I think that it was definitely a process that regulators and policymakers went through to kind of to get to those points. But I think that's where we got to, and it was definitely a fun and exciting time.
There are two symptoms that are really interesting recently, I think literally this week. So the former head of digital assets at TD Ameritrade focused on blockchain and figuring out how retail investors can access Bitcoin futures or so on, is now the chief innovation officer at the Federal Reserve. So that's a move. I don't envy her. Innovating at the Federal Reserve is a tough gig, but it's a huge signal. Another symptom is the SEC Commissioner Hester Pierce, who you maybe spent some time with during that sort of formative period, just gave a speech at the George Washington Law School where she said some pretty amazing stuff about what the purpose of the SEC is. She said, a part of ensuring that we are not hamstringing the ability of technology to make markets work better for more people is remembering that our role, the SEC's, is to protect investors and markets, not incumbents. And then, we regulators, mindful of the potential upsides and downsides, need to provide both legal clarity and the freedom to experiment so that DeFi can compete with centralized finance to offer investors financial services. It blows my mind that this is where we are at in 2021, because I remember in 2017, 2018, all of the initial coin offering issuances were painted largely with the same brush, right? And not the brush of startups or human nature, or things fall apart and some of it works and some of it doesn't, but with kind of a negative brush. And it really, to me, was just risk capital that led to the selection of the good projects, which today have turned into software, turned from ideas into software and into decentralized finance. And I think if you look at all of the issuances during that time period, they kind of rose over time from like 500 million to 5 or 8 billion to 20 billion. And then the sector cooled off, as you say. And now if you look at where the values are, there's something like $35 billion worth of stable coins in DeFi. I think the collateralized value in the protocols is about 50 billion. And so, and of course, all the prices are up, although that doesn't mean much in the current world of the dollar. But regardless, it's a secular shift. And now the software is actually deployed and doing stuff. And if you connect the lines together, it doesn't look like these disconnected market blips. It just looks like part of the same whole. And I think the other part of the story is Coinbase. And Coinbase, in a fairly short amount of time, building an absolutely insanely valuable business that's running at somewhere between 1 to 3 billion of revenue, is probably going to have a direct listing of 100 billion out there in the markets. And so I guess this is all an observation, but it's also a question of, what do you think this space is driving to? Is it the sort of brokerage trading coin for coin stuff like Coinbase is doing, or is there something underneath in the DeFi space that's really exciting and different?
So I think this is all so much more than that. I mean, I really think that this technology has the ability to and will in fact change the way mass numbers of people coordinate, especially from an economic perspective, especially from a financial perspective, but I think it's I think the implications are even broader than that. And I think that one kind of helpful way to think about this, at least for me, is Christian Catalini, who at the time was at MIT. He wrote a paper talking about the simple economics of blockchain. And the way he talks about it is the way he described it was essentially that anytime previously and still today, for the most part, when a large number of people want to coordinate their activity in some way, shape, or form, they typically need some type of technology platform or they need some type of intermediary to help kind of coordinate that coordination. That's fundamentally what things like Facebook and Google and Netflix and frankly even governments are on some level. Is they are a vehicle for mass coordination. And the way he described it was that when you have that type of system where you have somebody you have this mass coordination that is depending on some intermediary platform or actor to facilitate the coordination, what you ultimately end up doing is you end up granting effectively like market power to that intermediary. And as soon as you have to coordinate via granting market power to an intermediary, platform, actor, whatever, that market power, that actor with that market power can impose all types of kind of hidden costs that are quite harmful for the people relying on them to facilitate the coordination, because ultimately they are kind of appearing to act like kind of like a shared public infrastructure, but in fact they have this market power that lets them do all types of things, whether it's censorship, whether it's hidden costs or advertising or privacy things. Like there's all these things that at the end of the day users don't really have a great vehicle for pushing back on. And the thing that is so exciting about this technology is, as he explained in the paper, it is a tool, blockchain, and a kind of open source programmable blockchain like Ethereum and powered by cryptocurrency and things. It is a technology that can allow mass coordination of actors without granting market power to any particular platform or person or entity, because the coordination is facilitated by a protocol that is effectively open source. It's a set of rules that everybody can kind of contribute to or see. If the rules change, you can oftentimes kind of what's called fork and make your own version of it and change the rules back. And you can use cryptocurrency to help lower the cost of networking, the cost to get more people using the network. And so you finally have a system where coordination that is most valuable when there's a large number of people who do it, where you have network effects. You've got a system where there actually can be more real and efficient kind of competition at the kind of that intermediary, that layer that facilitates the coordination. And I think, the thing that is so exciting now as compared to 2017, in 2017 you were just starting to see kind of the proof of that. I mean, Bitcoin is an early example of how this type of system can work. Ethereum was as well, but now we're seeing more and more, as you said, Lex, real examples of protocols accomplishing various very valuable things, whether it's, I have an asset and I want to collateralize it and get effectively a loan, and I can do that in seconds and based on code and not weeks based on papers and banks and things, and lending markets, borrowing markets, all types of things that are popping up and allowing these mass kind of economic financial coordination via protocols. It's giving more and more kind of proof to this concept, which I think is really exciting moving forward. And I think Lex, as it's particularly exciting for us because we spend a lot of time working on these kind of financial applications in the context of Metamask, which is a crypto wallet from ConsenSys, and it's by far the largest, kind of most popular wallet for folks who are interacting with these crypto protocols, especially on the Ethereum network. And it is really purpose built for this future that, at least for me and I think many others, is so exciting. This idea where users are empowered, users can make choices, users can better kind of control their own assets and kind of financial destiny, and they can do so with efficient and effective coordination with millions millions of people around the world, as well as these, open, transparent, and community-owned protocols that truly are kind of like shared infrastructure. So it's super exciting.
Yeah, really well said. I think the MetaMask is such an interesting software because it's everything here can feel really unusual. On the one hand, it is your browser for the Internet of Value. It's your browser for accessing and permissioning your various assets that are connected to the chain. So you can use your browser to go to a website that sits on top of some Ethereum function or APIs, connects programmatically into a function on Ethereum, but you can't really do anything unless you permission that application to touch your stuff. And that's such a big difference from the traditional approach to commerce and to finance, where what you really have instead of a wallet is you have a bunch of lockers with your identity and your credit card information in every shop that you go to. So you go to Amazon and there's a locker with all your information, and you go to Facebook and there's a locker with all your information. And you go to Google and there's another locker with all your financial and personal information. And that's just not the way, that's not what's happening here. On the Internet of Value, it's totally opposite, where your wallet's in your pocket, and if an application wants to touch the stuff in your pocket, it has to ask you for permission first. And so, MetaMask does that. It does the unlocking of your stuff, but it also sort of incorporates into itself all of the functionalities that are being built into DeFi. So if DeFi has a trading engine and a borrowing engine and a payments engine and an investing engine and an insurance engine, then MetaMask is the world's best neobank, because it just has all that stuff by default in it, because it's the best way to access those interfaces. And so, we've done a bunch of work to have payments and trading functionality, but then the rest of the space is sort of incorporated as well. And I think it's just a matter of time before it becomes really clear that the financial services ecosystem coming out of an open source protocol with thousands of developers just has to be better than whatever proprietary solution is on the other side. I do have, one thing that we're struggling with, lots of people in the Ethereum space, is if this is supposed to be the best network effects come from the more users you have, the more activity and transactions you have, and therefore it's a multi-sided market, and the network becomes better and more valuable as a result of that growth. So because Facebook has all the people, it's the best place to find all the people. Because Amazon has all of the shops there are, it is sort of exponentially the better place to find all the shops there are. And that creates these really powerful network effects. The internet is the internet because it is better to have one internet. And the challenges recently has been Ethereum's become super popular. There's now 130, 140 million addresses, give or take. There are millions of people that are using it. Alone in MetaMask, 1.5 million a month. And that has created a lot of congestion and fees that the network charges to do its computational work. And so as more people have joined the network, it's become more expensive, and for many people it's become harder to use and kind of prohibitive to use, which is super frustrating because the kind of the core idea is so powerful and we're all aligned around it. That said, there are a number of things happening around a set of technologies called layer twos, which solve this. And so I kind of wanted to tee that up as a question around, in the work that we're doing with the protocol or with MetaMask or with Codify, or just more broadly in the ecosystem, how do you see these scaling challenges changing and finding solutions? And what are the sort of different paths that could come for resolving this transition?
Yeah, I mean, I think, one of the real benefits to operating in a space like we are, where, so much is just open source, open, transparent, is number one, it enables everybody to see, what is being valued, what problems need to be solved. And number two, it is very easy for, anyone anywhere to contribute ideas, code, solutions to solve those problems. And I think scalability of the Ethereum blockchain is a great example of that. I think it's, as you said, very clear that the things that people are doing on the Ethereum blockchain are quite valuable and quite valued by users. It's very clear that more people would like to be able to do more of those activities, and that, in order for that to happen, we as a community and industry need to kind of solve certain kind of scalability issues to bring down the costs and more easily facilitate more people to do more things. And I think over the last, I'd say, kind of 12 to 18 months, there's just been an explosion of kind of innovation around those issues. There's so many teams all around the world doing so many kind of different, sometimes similar, sometimes different kind of approaches to solving it. And I think there's just more and more kind of launching every day. And to me, at least, it's becoming quite apparent that there are, in fact, solutions, and they are coming. And frankly, some of them are already here. So I think that I think over the next 12 months, we will see several kind of different variations of layer twos pop up. I think that we will validate and learn from them, and we will also then be able to provide good user experience. I mean, this is hard technology, this is hard stuff, but I think we have the benefit, Lex, especially at ConsenSys, and especially working on and with Metamask, to really help make sure that users have kind of a safe, secure, but also just easy and good user experience as they start to use these different emerging technologies.
Like, I'm trying to paint a visual picture of how you're trying to dock, or how the industry is trying to dock these different protocols together, where all the DeFi stuff has been written on Ethereum, and is executed by the Ethereum computer. And then you have these other pipes that compute differently, that travel at very different speeds, that, like, if these were spaceships that you were trying to dock, they have different atmospheres, and they run on different code, so you have science fiction problems. Literally, your science fiction problems are that this one blockchain network is running this type of computational logic, and this other blockchain network is running a completely different computational logic. So you have to translate, like, the core of the code from one to the other through these mechanisms, and then it's just so alien and so interesting. But I think we're already seeing some preferred solutions coming out that are powering the DeFi protocols that have grown up on Ethereum but need faster, larger pipes, right? So, like, I think optimistic Ethereum is making its way forward, and XDAI and all sorts of other stuff. And then there is the institutional world. And so I think one of the bets that we've had for a while is the assets that are traveling on large institutional rails will also dock to the spaceship of Ethereum, and will also, flood with, whether it's equities or real estate or whatever, will also utilize these new mechanisms. How do you think about institutional adoption? And then, I guess, into that, how do you think about regulation and compliance today? Like, where are we in that journey?
Great questions. I'd say, I think, on this.
I'm keeping it easy. It's
Yeah, it's early in the morning for me, Lex. Come on, I've only had one coffee. Look, I think on the institutional side, I think the kind of general mental model that I think we've used is it's a little bit similar to the internet, right? Where early on in the early days of the internet, many companies, for a variety of reasons, were not comfortable with, or were not yet persuaded that there was sufficient value in interacting or doing much on the public internet, but started doing things on kind of private intranets. I think that we're seeing, we have seen and are seeing a similar kind of approach when it comes to blockchain. Many companies, many large enterprises, financial institutions, even governments are, quite interested in, the potential of this technology, and they're kind of exploring that potential, or even using that potential in production, oftentimes in some form of like what's akin to a private intranet, some type of private or permissioned blockchain, where they can, better control and mitigate some of the risks, sometimes compliance related, around the activity that happens on their network. But at the same time, we're seeing more and more of those institutions essentially acknowledging that, while even if they are doing that today, where they really want to get to is something more like the public internet, essentially something like the public mainnet Ethereum. And the reason is because when you start doing things on these large, open, permissionless, open source public blockchains, you get so much for free, you get so much out of the box that, it greatly increases security, it greatly lowers costs, and it allows you to do a lot more things at a lower cost. And so we've seen many institutions moving quite aggressively there. We're involved in Project Baseline, which is an initiative where EY and Microsoft and many other companies are, leveraging kind of public Ethereum blockchain to kind of verify database records across enterprises. But there's just many similar initiatives like this going on, and they recognize that kind of public blockchains really have some unique value adds. And so I think what we anticipate seeing is that in fact more and more enterprises will move there and will end up there, and those activities will be supplemented by these various methods and networks available in the kind of the quote unquote L2 space as well. So I think that's kind of what we're seeing. I think in terms of compliance and regulatory considerations, there is still lots of tough questions, especially if you're a large financial institution. Probably a lot of the listeners here will know. I mean, the financial industry and the financial industry regulation is largely built on, relying on kind of deputizing intermediaries to help accomplish certain goals. And while I don't think that blockchain technology will kind of remove all intermediaries, it does enable much more efficient and I think reliable kind of intermediation. So I think we're going to see more and more, better competition at the intermediation level. And I think, current intermediaries are going to be able to do more and provide more value and do more things that they just couldn't otherwise have done before. But all of this is, it's a bit of a process to get both industry actors as well as industry regulators and policymakers comfortable with the changes and the differences that this requires. And I think, we're still in the midst of that process. I don't think we're there yet, but I think, we're making lots of progress. And I think more and more institutions are, actively jumping in and actively trying to do real things in production with this technology and really kind of forcing the ball forward, so to speak.
Fantastic. Really, really well said. And, we're in an Elon Musk world now. That's where we're at. We're in a Tesla, PayPal, MicroStrategy, Bitcoin first world. And it feels like just a massive acceleration of everything we've been working on. So super great to have this conversation and to kick around the ideas. If people want to find you on social or the web, where should they go?
Oh, geez, Lex. You can tell I'm not good at self-promotion. I don't know. Ask Lex where to find me. I'm on LinkedIn. You can search for my name there. If Lex probably knows if there's a better way for me to to point you there. I think I'm also on Twitter. I don't even know my handle, but you can probably find me.
Fantastic. I'll put the link in the show notes. Thanks so much for joining, Pat.
Thank you, Lex.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.